Hello everyone. My name is Mark and I'm with FundScouter.com, a platform dedicated to helping investors navigate the world of private markets. I'm excited to be sharing an introduction to private equity with you here today, an investment strategy that has grown significantly in recent years and is now a key part of many institutional and individual investor portfolios. What we'll cover in this session. Our goal in this chapter is to set the foundation for our discussion on private equity by covering what private equity is and how it works, the types of companies involved in private equity, why private equity is considered a long-term investment. By the end of this section, you'll have a clear understanding of what private equity entails and why it has become an essential part of many investors' strategies. At its core, private equity, PE, is an investment in privately held companies, businesses that are not listed on public stock exchanges. These investments are typically made by institutional investors, private equity firms, and high net worth individuals. Unlike publicly traded stocks, where anyone can buy or sell shares at any time, private equity investments are made through direct ownership or specialized investment funds, and they typically require a long-term commitment. Investors in private equity aim to generate returns by improving businesses, growing their revenues, and eventually selling their ownership stake for a profit. To put it simply, think of private equity as behind-the-scenes investing. Instead of buying stocks of a company like Apple or Microsoft on the stock market, private equity investors work with private companies that are not available to the general public. These businesses could be small, family-owned enterprises, mid-sized companies looking for capital to expand, or even large corporations that choose to remain privately held. The scope of private equity: what types of companies are involved? The private equity universe is vast, spanning businesses of all sizes and industries. Some of these companies might one day go public, while others may remain private indefinitely. Here are the main types of companies that private equity investors focus on. First, startups and venture-backed companies. These are young companies with high growth potential but little to no profitability. Private equity in this space is referred to as venture capital, VC. Think of early-stage companies like Uber, Airbnb, or Stripe before they became household names. Small and mid-sized businesses? These companies have already established themselves but need capital to expand. Private equity firms invest in these businesses to help them grow or become more efficient. Large privately held companies. Not all big companies are public. Well-known firms like Cargill and Mars Inc., maker of M&Ms and Snickers, are private companies. Private equity firms often invest in these businesses to help them restructure, expand, or prepare for a public offering. Underperforming or distressed companies. Some private equity firms specialize in turnarounds, where they buy struggling businesses, make operational improvements, and sell them at a higher valuation. This is sometimes referred to as distressed investing or special situations investing. As you can see, private equity is not limited to just one type of business. It spans industries, geographies, and company sizes, creating diverse investment opportunities. Private equity is a long-term investment. One of the most important aspects of private equity that investors must understand is its long-term nature. Unlike publicly traded stocks, where you can buy and sell shares within seconds, private equity investments require patience. Here's why. Capital is locked in for years. When you invest in private equity, your money is typically tied up for 8 to 12 years. You don't receive returns immediately, as private equity firms take time to improve businesses and sell them at a profit. Illiquidity. Unlike public stocks that you can sell anytime, private equity investments are not easily tradable. Exiting a private equity investment often requires selling it to another investor in a secondary market, or waiting for the company to be acquired or go public. Value creation takes time. Private equity firms actively manage their investments, working to improve company operations, drive growth, and maximize value before selling. This process can take years, but is often worth the wait due to the potential for high returns. An excellent example of this long-term approach is Uber. Founded in 2010, it remained private for 9 years before its 2019 IPO. Early private investors saw substantial returns, while public investors only got access to Uber's shares much later, after much of the initial explosive growth had already occurred. For investors, This means that private equity is best suited for those with a long-term mindset and capital they don't need immediate access to. Why this matters to you as an investor, and why should you care about private equity? It offers access to a larger investment universe. With twice as many private companies as publicly listed ones in the US, ignoring private equity means missing out on a huge portion of investment opportunities. It provides potential for high returns. Historically, private equity has outperformed public markets over long periods. It allows investors to have a hands-on role in shaping a business. Unlike buying stock in a public company where you're just along for the ride, private equity firms actively work with management teams to improve performance and create value. As we move through this lecture, we'll explore how private equity investments are structured, the advantages and risks, and the different strategies investors use to capitalize on this asset class. Key takeaways from Chapter 1. Private equity involves investing in privately held companies rather than publicly traded stocks. The private equity investment universe is vast, spanning startups, mid-sized businesses, and large private firms. Private equity is a long-term investment that requires patience, as capital is typically locked in for 8 to 12 years. Investors seek high returns by actively working to improve businesses before selling them. Private equity offers opportunities that public markets do not, making it an attractive option for diversification and growth. Now that you have a solid understanding of private equity and its significance as an asset class, let's explore how investors can actually participate in this market. Traditionally, private equity investing requires long-term commitments, with capital locked up for 8-12 years. However, newer structures like feeder funds and evergreen funds are making private equity more accessible. These vehicles offer lower minimum investments and periodic liquidity options, allowing investors to participate with greater flexibility compared to traditional funds. At FundScouter.com, we compare these emerging new funds on performance, fees, and strategies, and helping a broader range of investors gain exposure to private equity. In later videos, we'll explore the two main ways to invest in private equity: direct investments and fund investments, and break down the roles of general partners, GPs, and limited partners, LPs, in the process.